Hello, hi, I'm Nick Burgess. I'm a quant analyst, and today I'm going to talk to you about American option pricing. And the format of what we have is that I have a series of PowerPoint slides I'm going to show you. And what we're going to do is we're going to go through how to price American options, what models are available. We're going to talk about the optimal exercise. When we're in the money in an American option, should we exercise now? Should we wait and exercise at a later time? We look at the models for pricing and how we cater for this. And then I'm going to talk through some of the theory behind pricing. I'm going to talk a lot about trees. Um, and so we can sort of get some intuition behind how we come up with when to optimally exercise. And we're going to look a lot at pricing spreadsheets just to gain a lot of intuition. So we're going to look at the theory, we're going to look at the practice, and we're going to have a lot of slides to take us through things. So without further ado, I'm going to present the screen and take you through the slides. Give me 1 second. Okay, so here we are sharing the screen. And if I maximize, here we are. So American option trading and analysis. Now, this is a four-part series. So we've already talked about American option trading, where we looked at US equity option markets, how we price, how we trade, what the broker screens look like, option chains and the Greeks. We also discussed trading strategies. We looked at directional strategies, income strategies, range trading, spread trading. We looked at quite a lot of different strategies there and give some examples of live examples of trading as well. And this section, we're going to talk about pricing and optimal exercise. We're going to talk about the pricing models, some of the theory, behind how is our live trading going to be working. Going to look a lot at optimal exercise, and we're going to look at Cox-Ross-Rubinstein trees, which are CRR trees, and we're going to do that so we can gain a lot of intuition behind optimal exercise. When to assign our options or not. And then in part four, we're going to look at live pricing of options in Excel such that we match the prices on interactive brokers and other trading platforms. So part three, pricing and optimal exercise. We'll be referring to an American option trading workbook, and the link for that workbook is here at the bottom. Okay, so here we go. Part three, pricing and optimal exercise. So pricing models for American options as a key challenge, and that is how do we know when to optimally exercise? So when our option is in the money, an American option has the right to either exercise at any time between the start date of the option and the maturity date of your option. So you can exercise at any point, and we need to know when is it optimal to exercise. So we exercise as soon as we're in the money, or if we wait a little bit longer, would we make more money? So how to model and capture exercise versus continue, and when we're in the money, should we exercise immediately, or could we earn more money if we wait? And the models have to incorporate and compare the option value with dividends, deposits, and interest rates, and it'll become clear why that's the case shortly. So the pricing models that we have available to us, there's quite a few models, and some of the main ones are trees, which we're going to look at today, and PDEs. They're going to be analytical approximations like the Bjerkson Stensland approximation. There are nested Monte Carlo simulation approaches we can take where we perform a Monte Carlo simulation of our underlying stock. And then when our option is in the money, we then run another Monte Carlo simulation to determine should we to look at future values of our option position and compare them to the current value so that we know should we exercise now or continue. And that's very computationally expensive. And then another approach which is very popular is the Longstaff-Schwarz method, which is often called least squared Monte Carlo. And just like the nested Monte Carlo, we run Monte Carlo to simulate the underlying asset price, so that in this case the stock price is. And then instead of running another simulation at every time you're in the money to determine whether we should exercise now or wait, we run a regression instead, and that's one regression per time step, and that sort of significantly reduces computational time, although it's still computational intensive, not as intensive or expensive as running a full nested Monte Carlo simulation. So that's a very popular approach. So these are some of the pricing models available. We're going to look a little bit at trees in this session because they're very, very intuitive and give us there's a lot of visuals that we can get to where we can gain easy intuition. But before that, let's talk about optimal exercise. So it's never optimal to exercise American options early, except, and we're going to look at those exceptions. So early exercise of American options, this means we sacrifice and give up any remaining time value. So if you exercise an American option sort of halfway through the life of the option, you sacrifice the time value of that option. And so simply put, practitioners never do that. They just choose to sell the option instead. And that just means people don't exercise their options when they're in the money. They just sell the option instead because they don't want to lose the time value. Now, American call options, the right to buy at the strike price. Sometimes we want stock dividends instead of the option, and it may be optimal to exercise a call options depending on dividend levels. And let me explain. So it's never optimal to exercise calls on non-dividend stocks. So if there's no dividend, it's never going to be optimal to exercise an American call early. Um, Call option holders, when you do not receive any underlying stock dividends. So sometimes it's optimal to exercise your option if the dividend value that you would receive from exercise is going to be greater than the option value itself. And so sometimes what we find is that when call options are trading near just before their ex-dividend dates of the stocks, sometimes we find if the dividends that have been announced are going to be larger than the option value itself, we will exercise our options to receive that dividend instead. So sometimes for very large dividends, we might choose to exercise the option to receive that dividend. Now, what about put options? So put options give us the right to sell the stock at the strike price. And sometimes it's optimal to exercise these early if the cash profits that we're going to receive from exercising the option um, can be put on deposit and earn more money from that deposit. So early exercise can be optimal if the put option is deep in the money and interest rates are high. So the holder would exercise to place the strike on deposits. You sell your option, you sell your stock, you're going to receive the strike price, and you can put that on deposit. And we would only exercise early when that cash deposit, the value of that cash deposit, is worth more than the option value. And that generally is only going to be the case when you're deep in the money and when interest rates are high. So those are the main conditions. So for call options, sometimes it's optimal to exercise them early if there's going to be a large dividend. Put options, we may exercise those early if interest rates are high and we can put any cash proceeds from exercise on deposit, and that deposit's worth more than our underlying option. Um, okay, so those are the main conditions, and these are the things that we want to try and capture in our models. Now, before we proceed, we need to talk about delta and the probability of exercise. That's actually very useful for trading. So delta measures and is defined and measures the change in the option price for a $1 move or a 1 unit move up in the underlying asset. It approximates the probability of finishing in the money. It's not the probability of finishing the money, but it's close to it. And the delta is measured as N phi D1 or ND1. Phi is 1 for a call and -1 for a put. And N is the cumulative normal density function. And this is an expression that comes from the Black-Scholes formula. So D1 is written here on the right. Here, what we've done is I've written out the Black-Scholes European option pricing formula. And in the formula, for a call and for a put, there's an N term, which is the cumulative normal density function. And it has a D1 and a D2. For calls, it's plus D1, D2. For puts, it's minus D1, D2. And so D1 is this expression here. And we take these parameters from our option, our American option. And delta ND1 for a call ranges between 0 and +1. For a put, it ranges between -1 and 0. And that's just because delta is measuring up movement in the underlying asset. Calls gain value if the prices increase, and puts lose value if prices increase, or rather that they gain value when the price decreases. Hence the sign difference there. So calls have positive deltas, puts have negative deltas. So that's the delta. So it's measuring the change in option price for $1 up move in the underlying asset. Black-Scholes ND2. So that's the other sort of term here in the Black-Scholes formula. So ND2, or the cumulative normal distribution sort of function with D2 as its parameter, that by definition, that measures the risk neutral probability of your option expiring in the money. So this is exactly the probability of exercise. Um, so the probability of exercise is N phi D2, so where phi is 1 for a call and -1 for a put. Now, one thing to note about this, we said that in many cases, the probability of exercising an American option early is going to be pretty low. So, I mean, you either have very large dividends for a call, or you're deep in the money for a put, and interest rates are high. So, whilst the probability of early exercise is not zero, quite a lot of the time, like if you're trading an IB broker, you will find that you're never exercised against. You never find that you have an early exercise. It's pretty rare. And so, whilst ND2 and is coming from Black-Scholes, which is a European option pricing formula where there's no possibility of exercising early, people use this for American options too because it's a close approximation, and there's an implicit assumption that dividends are not too large, interest rates are not too high, your option's not too deep in the money, loosely speaking. So this is an approximation for probability of exercise for an American option, and then more of a model exact method for European options. So you'll find that the European ND2 is used for the probability of exercise for American options on many broker platforms. It is a very close approximation. It's not a bad estimate. Now, we have some, as we're coming on to the in terms of the pricing models, and we have some pricing preliminaries where we're going to talk about martingales and risk neutral pricing. And this is to allow us to look at the pricing models for our American options. And there's sort of two key takeaways I'd like us to look at. Now, we don't need to remember everything on the slides, but it's quite helpful if we can remember these blue formulas and the key ideas. So there's two slides for these preliminaries. Now, the first one we're going to look at is replication portfolios and no arbitrage. Now, an option can be priced by using a replicating portfolio, and its payoff or this portfolio is using self-financing. It's arbitrage free, and the portfolio is made up of stock and cash. So we can price an option using a replicating portfolio, and there'll be no arbitrage between the portfolio and the underlying option because it's self-financing, which means there's no cash going in or out. There's no profits being made or lost. So that's the idea on this slide. I'm going to take you through that. And it's this blue sort of formula that we sort of need to bear in mind. So the first thing is we create a replicating portfolio to replicate the option payoff. We hold delta units of the stock S, and we borrow or lend cash amount of phi BT. BT is the savings account. The savings account has a value of exponential RT. And at inception, the savings account has a value of 1. So this is like a discount factor, but this is a growth factor. And we invest phi in a savings account B. And the idea is we're not trying to fund the stock position, but we're trying to replicate the option price. That becomes clear what I mean in the next step. So the portfolio value, this replicating portfolio value, has a cash value at time TB. And so the value of the replicating portfolio is delta times the stock price plus phi times the cash account. And what I'm trying to sort of say in that last sentence is that it's a very common mistake is when we're picking these weights, delta and phi, so delta units of stock and phi units of cash, we're not trying to self-finance in the sense that we're not trying to make this funding component match the stock price. We're not trying to fully replicate the stock. The idea is that when we have the stock and some cash, there'll be some leftover, and that leftover will be the value of the option. So what we're trying to do is we're trying to find how much stock and how much cash do we need to replicate the value of the option. So we're not trying to use the cash component to fund the stock position. We're looking for the cash component that balances its portfolio such that the stock and the option, so that this portfolio matches the option price. That's quite an important point. It's very subtle. Now we pick portfolio weights delta and phi. They're calculated using stock prices and option values from the next time period. So if we're doing Monte Carlo simulation or if we're performing a tree, you look at where the stock and you look at the value of the portfolio one step ahead, and then and delta is based on that. So it's a recursive formula working backwards from option expiry. That's what I'm trying to say, and that allows us to sort of build our trees in the Cox-Ross-Rubinstein model, which we're going to look at next. So the value of the replicating portfolios here is delta of stock, phi of cash. And that's the key takeaway from this slide. And the other thing to sort of say, it's self-financing, it's arbitrage-free, and this portfolio here will exactly replicate the price of the option. Now, the last thing to sort of say is about self-financing and no arbitrage. All changes in the replicating portfolio value in the replicating portfolio in its value arise solely from asset price movements. So the changes in the portfolio uh, are only coming from stock price movements. No external cash is being added or withdrawn. This is called self-financing and ensures no arbitrage between the option and the replicating portfolio. So what that means is there's no profits or losses being made on this replication portfolio. So it's self-financing. If there were profits or losses, if there was a profit, you would buy the replicating portfolio and sell the option. And if there were losses, you do the reverse. And because there is no sort of cash going in or out of this portfolio, there's no profits or losses, there's no arbitrage, and therefore we can the value of this replicating portfolio will be the value of our option. And so that's the key takeaway here, that this value here, the value of this portfolio is the value of our option. And this is what we focus on. Now, the next slide, the key takeaway here is this blue formula at the bottom, which is allows us to calculate the probabilities of moving of stock prices going up or down. And we'll come to, so the key idea here is that using the risk-free savings account as the numeraire, or the funding asset in our portfolio, this defines a risk-neutral measure Q, under which the discounted value of any payoff equals the current asset price. That's the key takeaway from this slide. And that's the key property that we need to be able to work out what the probability of the stock price going up or down are. And that's what allows us to value the value of our option. So let's look at the steps involved in that statement. What do we actually mean? So we have a tradable asset and a numeraire. This is the benchmark asset used to finance the replicating portfolio. So the benchmark asset is called a numeraire, and it must be a tradable asset. And this benchmark asset sets the value of the units of value and defines an associated probability measure where the expected growth of the asset or portfolio matches the growth rate of the numeraire. So what are we trying to say here? We're trying to sort of say that we need a fund. So when we were creating our replicating portfolio, we had delta units of stock and we had phi units of cash account. And cash account, whatever we choose for the financing component of our replicating portfolio, that's the benchmark asset. Call that the numeraire. And that numeraire determines the units of what we're pricing in. So most common benchmark assets would be cash, maybe in dollars, cash in euros, cash in pounds, yen. So it sort of sets the units, how we want to price our portfolio. Do we want to price in dollars or some other currency? But you could also price in stock terms in other sort of stranger units. It don't have to be sort of cash units, but the benchmark asset is the funding, is the asset that we use to finance the portfolio, the replicating portfolio. That's called a numeraire. So it sets the units of value, and it also defines probability measure. So if you pick cash as the numeraire, then we're saying then that the portfolio will grow with the same growth rate as that numeraire. So if cash grows at the risk-free rate, your portfolio will grow at the risk-free rate. If you select foreign currency as your benchmark asset, then the growth of your portfolio will be measured in that asset. So that's what we're seeing here. So the benchmark asset controls not just the units of value, but also the probability measure, and that controls how your replicating portfolio or your underlying asset grows. Now, when we select savings account as the numeraire, cash, when we select the numeraire as the risk, when we select the savings account as the numeraire, then the risk, then the numeraire is the risk-free savings account, i.e. cash, and the corresponding probability measure has a name. It's called risk neutral or the Q measure. So it's the risk neutral measure or the Q measure. So savings account is grows at the risk-free rate, so we call it the risk neutral measure or the Q measure. Now, the risk neutral pricing, when we use the Q measure, the expected value of the self-financing portfolio grows at the risk-free rate. This is just leading on from point two. So it follows, and this can be confirmed by using Ito's lemma or differentiating the portfolio value V with respect to T. So if we were to apply Ito's lemma to the replicating portfolio value, you'd see that it grows with the risk-free rate. But that's only because we're using cash as a benchmark asset or the numeraire. So under this Q measure, we grow at the risk-free rate. Now, this is the key point of the slide, the martingale property. I'll explain this through for you. So discounting removes this risk-free growth. The expected value of any discounted payoff has zero drift and equals the current asset price. That means it's a martingale under the Q measure, and thus gives this expected value formula, which is the key result that allows us to price options. Now, let me explain that to you. We said in step 3 and step 2 that when you pick your tradable asset as your numeraire, that's going to control the units, and it's also going to control the probability measure. And the probability measure, your replicating portfolio is going to grow in this case, at the risk-free rate. So we picked cash, the risk-free savings account, as a benchmark asset to finance the position, to finance the portfolio. And because of that, it means then we're using a risk-neutral or Q measure, and then which controls the growth rate of your portfolio, of the self-financing portfolio. So we're saying the growth of the self-financing portfolio grows at the risk-free rate, which is the same as the benchmark asset. And so we want to eliminate that growth. And so the idea is that if we discount by the risk-free rate, we remove the growth from our process. And then that means that the value of the discounted payoff is equal to the current price. So I should say this a bit more clearly, is the expected value of any discounted payoff has zero drift because the discounting undoes the growth that we were getting from the risk-free rate growth that was coming from the Q measure. So discounting is reversing that growth, and therefore, because of that, we have no drift. The expected discounted value has no drift and equals the current asset price. This is what it means when a process is a martingale under the Q measure, and this means that this explains this blue formula here. So the expected value under the Q measure. So this means when we're using cash as the benchmark asset or the numeraire, then the discounted future value of the stock is equal to its current value, and that's something that's a key result that allows us to value options. And because knowing this formula allows us then to work out what is the probability of an uptick in the stock price or a downtick in the stock price. And once you have those probabilities, we can, those risk neutral probabilities, we can then price that's all so that's the missing component that we need later on for pricing and valuing our options. So the key result is this one here, that under the Q measure, under the risk neutral measure, the discounted future value of the stock is equal to the expected discounted future value of the stock is equal to its current price. That's the key result that I want you to be aware of. So if you only remember two things from these slides, it's these two blue formulas, is how to value the replicating portfolio, and then this key result that says the expected discounted value of the future stock price is the current price. Those are the two things to remember, and everything else around this was just to explain how did we get those two key results. So if we move on to American option pricing, we're going to look at a case study using where we apply this to the Cox-Ross-Rubinstein model, and we picked this model because it's very analytical tractable, it's easy to work with, it's very easy to visualize, and it's very easy to customize as well. So it's a great model. It's one of the basic. It's a basic model, but it's a very good one to gain intuition. So here the model. Firstly, we're going to just give some preliminaries about how the model works. Then we're going to talk about implementation, and I'm going to show you how it works in an Excel spreadsheet. So the first thing is Cox-Ross-Rubinstein model. I'll refer to that as the CRR model. It's an excellent model to gain pricing intuition before proceeding into more complex models. It's very easy to adapt and customize and visualize. The model we model stock price evolution as a binomial tree. And we use standard deviation, which is measured as sigma root t, to estimate up and down moves in the underlying stock price. We then use martingale theory to compute the risk-neutral probability of an up move p and a down move 1 minus p. It's 1 minus p because it's only two states. Total probability is 1. So if an up move is p, a down move must be 1 minus p. So we don't need to calculate an up move and a down move. We just need to know an up move from which we can calculate a down move. So these are probabilities. And as a final step, we compute the discounted expected value, which allows us to price our options. So if we use looking at how are we going to apply the martingale theory that we just looked at in the previous slides? So we're saying that the expected stock price at the next time step under risk neutral probabilities P for up and 1 minus P for down. We know that the expected value of stock at the next time step of a tree model is going to be P, which is the probability moving up, times the value of the stock price if it moves up, which is S times the up move factor, plus probability of down move times the value of a stock in the down state. So that's S times a D down factor. And I'll explain why we get these D's in use shortly. We're using standard deviation. So this is so P times the probability moving up times the stock in the up state plus the probability moving down times the stock in the down state. Now, we know we have some extra information. And this is where we use the critical result that we discussed on previous slides. So under the risk neutral measure Q, so when we're using cash, the cash account as our numerator, then the discounted expectation of the stock process is a martingale and therefore equals the current price. So if we discount everything that we see here in the expectation on the left side and on the right side, if we apply a discount factor to both sides, we can sort of say, we can see here, I've applied a discount factor here, exponential minus R delta T to both sides. But we now know that the discounted expected value is the current stock price, which is S. And so we have S is equal to everything we see on the right. Now we can rearrange this for the risk neutral probability P, noting that S terms cancel, and then we get this formula here. So this tells us the probability of a risk neutral probability of an up move. Assuming that we're in this binomial tree sort of framework. And then 1 minus P will give us the down move. And this is a key result that allows us to price our options. So all because of this martingale theory, we can make this, we have this fact that this expected discounted future value of the S is equal to the current price. And that simplifies this whole expectation, allows us to solve for the risk neutral probability of an up move. Now, in terms of implementation, and then we'll have a look at how it looks like in Excel shortly, the steps are as follows. So the up factors, we build a stock price binomial tree. So you have a stock price at time 0, and you can have an up move or a down move. And so this stock price in the up state is just the current stock price multiplied by an up movement factor. And the down state is the current stock price multiplied by a down movement factor. And they will look very much like growth rates or discount factors, these terms. So we have the up factor is measured as exponential plus sigma root t. Now, sigma root t is a standard deviation. So this is like an up growth factor, and then a negative up growth factor. So we're either growing or we're discounting using standard deviation as the term, the growth or the discount term. Now, the standard deviation is sigma root t, or changing t. So we build a price binomial tree this way, using these formulas. So it's S multiplied, the current price multiplied by U to get an up move, and S multiplied by D to get a down move. Then we compute a table of values. So at each of these stock, so we build a tree with these, we work out what an up move and a down move would look like in many different states. We have a tree. I'm going to show you all this in Excel shortly. And then we have a separate table where we measure intrinsic values at all those points, which is just the difference between the spot and the strike. So for a call, it's maximum of S minus K and 0. And for a put, it's the difference between K minus strike minus spot. And 0, so that's for a put. And so we calculate the intrinsic values of each of these stock price states, each of the different nodes in our stock price tree. We calculate the intrinsic values, and that's the value of exercising now. So where you lose your time value, and it's all intrinsic value or internal value. So that's the exercise now price, and then we compute the continue, and then we compute at each of these nodes. We compute the continuation values, which is where we don't exercise now, we exercise later, or we hold and we continue, and that's calculated. So the value of the option at each of those nodes is the probability of moving the probability moving up times the value of the option moving up plus the probability moving down times the value of the option moving down, and that's discounted. And that's just time value of money. You just say, okay, we look at those values in the future, we bring them back to today's node, and that's where that discount factor comes from. And then the final node in that continuation tree is just the intrinsic value. It's just the payoff at expiry because there's no time value. Now, once we have these trees, so we compute a stock price tree where we look at the different states of the world and what happens if stock prices go up or down over different time steps. Then we look at the exercise now values at each of those points, and we look at the continuation values at each of those points. And then the option price is the maximum of the intrinsic value and the continuation value. So that's the maximum of exercising now or exercising later. And that's how we incorporate the early the option to exercise early. In effect, that's how we price American options. So let's have a look at what that might look like in a spreadsheet. So I'm going to show you some screenshots here of the spreadsheets, and then we're going to jump into them as well. So we know that the stock price dynamics, we say, have a variance of sigma squared t. And so therefore, the standard deviation is just the square root of that, which is sigma root t. And then we're going to say that stock prices evolve have an up factor of exponential plus sigma root t, sigma delta p, and a down move, same thing but with a minus. These are very similar to growth and discount factors for interest rates. So growth factor would be exponential RT in the interest rate world, and the discount factor would be exponential minus RT. But instead of using RT here, we're using sigma root t, which is, so we just use it. So instead of saying interest rates grow with risk-free rates, we're saying stock prices grow with standard deviation, and they may grow upwards or they may grow downwards. They may, yeah, exactly. They may grow or they may discount. And that's what you can sort of see happening here. I'll explain this a little bit more detail. So we have an American option here, pricing a put. Asset price is S, is 100, strike of 100. Time to maturity is 1 year. Risk-free rate is 5. Cost to carry is 5. Cost to carry is defined as the risk-free rate minus dividend yield. So in this sense, we're saying there's no dividend yields because they're the same. Volatility 10%, and we get an option price of 2.4. The analytical price, this is a tree price, and then I have an analytical implementation, which is 2.41. There are many models we can use, but this is me checking against analytical approximations. And so you see the trees performing quite well. Now, the number of steps I've used here is 10. So the time step is this 1 year divided by 10, which is 0.1. Up move, if we compute this exponential sigma root t, we get 1.03. So it grows by 3% each period. And a down move sort of reduces by a similar amount. So that you see the next move is going to be 96% of the current value. And then up move is going to be 103% of the current value. The probability of an up move, using the formula from the previous slide, the probability of an up move is 57.13, and the probability of down move is 1 minus that. And we have a discount factor of this, 0.99501. So those are the parameters coming out of the model. And that's everything we need to do the pricing. So firstly, we compute a stock tree. I've got 10 steps, and you can sort of see spot price times U is gives you 103.21, which is just this up move factor here. And then the spot price 100 times the down move 96887. That's then the down price here, 96. So you just multiply the to get the current node. You can multiply the previous node by down move, or if you're in the middle, you can multiply the previous node, could be down or up. You pick either one. If you pick the up state, then you say, well, okay, you've gone up and then you've gone down. So you multiply the previous value by down. Or you can if your path is coming the other way, you can sort of say, well, if I went down first and then up, then I would say 96.89 times an up. And whichever path you take, you get the same value. So you just multiply, you select the previous node, and then if you want to move down, you multiply by the down factor. And if you want to move up, you multiply by the up factor. And you just repeat that process and fill out the entire tree. Now the color coding here, just blue, green just means I moved up, red it means I moved down, black is I've stayed the same. It's just to help us visualize. So you build this stock tree for 10 steps. You can build it for as many steps as you like, and the more steps, the more accuracy. But obviously, more computational power is required for more steps. And so after you build that stock price tree, we can use that then to compute the exercise now, or the intrinsic value. So for a call, it's S minus X and 0. For a put, it's the maximum of X minus S, the other way around. And so this is for a put. So as prices fall, you can see we have value. As prices go up, we have no value. So everything here is kind of just 0. Anything below here has some intrinsic value. So there's some value to exercising should prices fall below 100, because our strike is at 100. And then we compute the continuation values on is another tree that we build, and we're going to compare the two. Now we know that the probability of we computed the probability, risk neutral probability of an up move using the formula that we got from Martingale, from our Martingale theory, and that's this formula here. And we've populated those results here in the previous slide. So we've computed P, which is what we have here, and then we're going to plug it into the discounted expected value sort of formula here. So we, at each node here, the first thing we do is that there's no intrinsic value, there's no time value, sorry, at the extrinsic value. There's no time value at the last step, because that's maturity. And so that's just going to be the intrinsic value, which is the same as the exercise now value. You see all of these are the same. And then this formula is applied recursively from the back. And so at step 9, in this case, step 9, we calculate what's the probability of an up move and what's the probability of down move. Scaled, we're basically going to apply this formula. So if you look at this point here, the very top 9th step, we compute that as we know the probability P of moving up times the value of moving up, and then plus the down move plus the value of the option moving down. So 0 and 0 in this case, and then we discount that. Now, if we come to this first value here, the first value that actually has this non-zero value, this red one, but we multiply P times the value of moving up, which is 0 in this case, and then multiply 1 minus P, which is the down probability, times by this expect 1.3 value. And that's the so we need this payoff value to be able to apply this formula. And then we just discount the value. And that gives us 2.61 of this node. And then we just repeat this valuation formula here all the way through to compute all the continuation values for the entire tree. And then we will come to a final price here, 1.82 as for continuation value. Now so this is continuation value, this is exercise value, and then we take the max of the two. That's the idea here. Now, one thing to sort of say here, what have I done here? I'm highlighting in red for the option parameters that we have. I formatted the spreadsheets to show up in red if the continuation value is greater than the exercise now. So if it's red, it means we don't exercise. In this case, it means that or rather, it's the other way around. It's the exercise now value in this case is higher than the exercise later. So it's the opposite. So you do exercise now. It's the other way around. And you'll find from my example, and the reason for that is in this case, I'm a put option and I've got interest rates quite high. And therefore, it's optimal to exercise and put the cash, your strike, on deposit. So here's me sort of comparing here now. What's if we take the maximum of the continuation value and the intrinsic value, you'll find some of these nodes then will get replaced by the maximum, by the intrinsic value. And then when you make those adjustments to your tree, because of this max formula we're applying, and you find that the value of the option is 2.4, which is basically the front node. So you're getting here the values of the replicating portfolio in different states of the world in different times. So for each time step 1 to 10, so 10 is expiry, 0 is the current current time, and then you're sort of seeing the price in the up state or the down state for all the different states as possible through the binomial tree approach. And so if you look at the value, so then we can look at the value of the option at time 0 and sort of say, well, that's the value of this put option is $2.4. per contract. But then you can also see the value of the option in different states of the world and different time points. And the nice thing about this approach is it allows us then to sort of play around with the model and sort of see, well, how will things behave if interest rates change, if volatility changes? What if we put barriers in our option? What if we structure it to be something, to be something a slightly more exotic product? What if we customize our trade? It allows us to do a lot of things because you can sort of play around with the state of the world, and we can introduce new features very easily using this kind of approach. So I built a spreadsheet just to demo everything, and I've shown you here how it's a really nice summary of how it all works. I'm going to switch onto the spreadsheet very quickly. So we've got a put option here. We said the analytical price is 2.41. CRR price with 10 steps is 2.40, which is pretty good. And you can sort of see the interest rates are 5%. There's no dividends in this case. Carry is 5 as well. You see all our parameters. How did we calculate the up move, down move, up probability, down probability? Everything you need to know is in terms of parameters is here. And then what is left to remain is that you have all the information you need to build this tree to replicate stock prices going up and down. We also then we know how to compute the intrinsic exercise value, and we also know how to calculate the whole value. And then we just take the maximum. Do we exercise or do we hold? And then that's how we incorporate the optimal early exercise feature. Now let's have a look at that spreadsheet. I just want you to sort of see how it works. So the reds here are telling us exercise early. Now, as you can sort of see, if I'm a call option, it's not optimal to exercise early because I've got no dividends. Now, if I start applying dividends, if the dividends are greater than my stock price, it will be optimal to exercise early. So if I make this dividend big, you can start to see then, okay, for this call option, at these time points, it's optimal to exercise early. So because we have our dividends. And also, if we increase, we can play around with the volatility and other parameters, but we can sort of see the impact. But if we don't have any dividends, then it's never optimal to exercise early. Now, for a put option, we said that if the interest rates were high enough, then we could exercise early, put our cash in deposit. But what if there's no cash to put on deposit? I mean, what if the interest rate's zero rather? So you earn nothing from putting things on deposit. Then the put option is never optimal to exercise early either. So if we return that back to 5. Now, if we lower the interest rates, you say, well, look, then what I'm trying to sort of say here, the Cox-Ross-Rubinstein approach and the tree being able to price as a tree gives you a very nice way to visualize optimal exercise, gives us a very nice way to sort of understand what's going on, to play around with the parameters. And in this case, the put's not deep in the money, but we can put it deep into the money, and we can play around with the risk rates. So if we sort of said, the right to sell at sort of 50, I mean, it's just, or something really high, we sort of say that's 20. So you say, look, if there's no interest rates, I'm deep in the money, but if there's no interest rate, I'm not going to earn anything from placing my cash in deposit. So there's no point exercising early. But if there is interest rates, then there is. So it allows us to play around with our assumptions, see how our model behaves, and experiment and just understand how things work. Now, this is the 10-step one, which I just put together for intuition. Now, if you want to sort of what I've also done on the spreadsheet is I've put together something a lot more robust, where you can actually increase the steps to as many steps as you want, because 10 times steps not very large. But I've allowed us to sort of in this spreadsheet to go up to 50 times steps and still gain that intuition. It's plenty of steps, and when you expand, or if you want to hide and sort of see all the different rows, maybe because it's quite hard to navigate with such a large table, just press the resize and it'll refresh all these table sizes for you. But otherwise, every time you change the number of time steps, it will automatically update. It's a small macro in there for you. So if we go back to 10 time steps, you can sort of see, here's my stock price tree, up moves, down moves. Here's the intrinsic value. So that's the value of exercise now. Here are the values if you, sorry, let's resize that. Here's the value if I, here's the value if I continue, if I don't exercise now and I just say hold. Reds are showing where it's optimal to exercise early. Early exercise, I've also sort of flagged them here with ones and zeros. And then you can sort of say that you take the maximum holder exercise. And so it's a really nice way of visualizing where would you hold, where would you not hold, where would you exercise early. And that's really helpful also if you're trading because you can sort of then gain intuition around when when you may have options assigned against you early, which is quite rare in my experience. But this would give you a guide, a very good guide as to when you might have any options with your broker, sort of if you trade options assigned against you early rather than having them assigned at maturity. So whenever you get near, so I would sort of say whenever you're near ex-dividend dates on stocks, if the dividends are large, you have to pay attention, especially if it's larger than your option value. You may you probably will be assigned. And if interest rates are high and your puts are deep in the money, you may also get assigned then as well. So these kind of spreadsheets, these kind of tools, not only do they replicate the pricing that you would see on trader platforms like IB Broker, they're also going to sort of help you to gain intuition about when you may get assigned. So not only can you calculate the probability of assignment as ND2, and you can also gain more intuition about exactly when and in what conditions would trigger an assignment. So it gives you a lot of understanding about the positions that we're trading when we're trading options on platforms like IB Broker. Now, if I jump back into the slides, we let's go back into the screen. So I wanted to show you this spreadsheet. It's I'll put the links to the spreadsheet in the comments. There's an American options spreadsheet, but there's also which has a Cox-Ross-Rubinstein model in there, which is just the 10-step one. But if you want the more elaborate one, it's a separate spreadsheet, and I'll put it in the links below the YouTube channel. Now, so in terms of pricing methods, what is the best method to use for American options? Well, my favorite is the Lysen-Reimer tree because it's fast and accurate. And the Lysen-Reimer tree is implemented in the American option pricing workbook. And the difference between this tree and the Cox-Ross-Rubinstein tree is it's more accurate for pricing options that are not at the money. So what it does is instead of modeling in the Cox-Ross-Rubinstein tree, we build the tree starting from the current stock price. And in the Lysen-Reimer tree, it builds a tree around the strike, evolving around the strike instead. And so if the strike's far away from at the money, the tree the stock price tree in our Cox-Ross-Rubinstein model may not touch many of the, it may not cross over the strike many times. So when you look at all the different paths, they just don't interact with the strike much. When the strikes that are further away from at the money. So what we do is they build a tree around the strike prices, and we evaluate the tree around that, and then we scale the probabilities. We normalize the probabilities back to the original ones. Using something called a Fisher-Pratt inversion scheme. So they build a tree around the strike instead of the current spot price, and then we adjust the weights, the probability weights, to keep everything in sync. And the reason we do this is that then the tree then sort of the paths on the tree cross over the strike more often and interact with that. And then it gives you better feel of what's happening around the strike, whether you get exercise or not, and it gives you a better price. They also converge very fast, very accurate. So it's personally my favorite, and it's very quite easy to customize, just like the CRR. Now, the other approach that I also really like is long stash charts. It's very rigorous, but it can be a little bit more computationally intensive, but it's also a great approach to take. There's no right or wrong, but these are my favorites. So why did I use CRR in this presentation? I used it here because it gives excellent visual representation. It's very easy to experiment with and to test all the different early exercise conditions. And it's very easy to customize for barriers and exotic option types. So it's very easy to play around with, very easy to set up, and mathematically quite straightforward. Now, that's the end of this presentation. Now, for more information, you can. There's a lot of resources we have available. I keep all these kind of contents will be on my Quant newsletter. It has an archive, so you can go in and actually explore all the different topics we've covered in past newsletters. You can subscribe to my Quant YouTube channel. I have a Quant trading, algo trading and Quant store where you can sort of find all the different spreadsheets and materials and training courses, and you can also follow me on LinkedIn. So thank you for your time. Please do subscribe to this YouTube channel, and I'll see you in the next part. Thank you for your time.